Hey, what's going on, everybody? Max here with BB, and today for 10 minutes max, we are going to be talking about why this is actually a very big week for the macro. I know it's not the most fun topic, but unfortunately, it does matter quite a bit right now. And we have a big week, as Barry Silbert likes to say. So, check week, big week. Before we dive into the charts, guys, if you could do me a solid and please like and subscribe, that would be absolutely fantastic. We are growing so quickly, and it's all thanks to your guys' consistent support of what we are building here. So, before we share any charts, we need to set the stage a little bit, and I'm going to show you guys an economic calendar. First things first, so today's Monday. If you're watching it late, today's Monday, April 29th. April is almost over. So far, it's been kind of a choppy reaccumulation style of month, but ultimately things still look pretty good. But let's talk about why this week is big. So one, like I just mentioned, it's April 29th. All right, we're coming into, the end of a month, and the calendar rollover does matter quite a bit. So, it's looking for crypto like this is going to be most likely a red month. Stocks, it's kind of a mixed basket for individuals, but we'll talk about that in a second. So let's look at what we have scheduled for this week and why it's important to actually take a look at this stuff. Now, again, I know you want to see altcoin charts and stuff like that, but this stuff actually does affect your altcoins. So the more ingrained that crypto becomes as a global asset, and the more it becomes sort of merged with TradFi, the more this stuff does matter. So there's a time and a place for it, but really, let's skip to Wednesday. All right, so some important information here on Wednesday. So we have FOMC, first of all, on the 1st. So FOMC is going to be, just think of it as really for all intents and purposes, it's going to be your interest rate policy decisions. Are we going to get a pause or a continued pause? Are they going to begin to cut? What are they going to tell us? It's all but a certainty that we're going to stay paused, and we're gonna pull up that website as well and talk about that. But Wednesday is really big day, right? We're going to hear from Jerome Powell. He's going to basically tell us that we're going to remain paused. But as grown men, we have an obligation and a duty to wildly speculate and read between the lines on what we think he really wanted to say when he actually couldn't say it. So, it's all but a lock that we're going to stay paused. But the big question is what's going to happen after that. Okay. And again, we're going to get into all the details. I just want to go through the calendar here. So interest rate decision on the 1st, okay, on Wednesday. Thursday, we have initial jobless claims. And then Friday, we have U.S. unemployment rate, okay? Wednesday, interest rate decision. And then Thursday, Friday is how strong is our labor market, okay? Now let's jump over to a different page here. And we are going to actually look at this. And then we're going to dive into some charts, all right? But this is important. All right, so if you guys can see this here, it's not as big as I would like it to be here. Oh, looks like I can zoom in. Perfect. Okay. Like I just mentioned, May 1st, we have our FOMC meeting. Right now, this is the rates are right now. Think of this as a 525 to 550 is basis points. So just add a decimal point between the 5 and the 2 and the 5 and the 5. So it's 5.25 to 5.5%. Okay. So for the May 1st meeting, there is a 97% chance that we remain exactly where we're at. The June 12th meeting, 88% chance we remain exactly where we're at right now. July 31st meeting, same thing, 70% chance that we remain exactly where we're at right now. Now, going into the September 18th meeting, there's a 45% chance that we actually get a 25 basis point cut, but there's still also a 40% chance that we don't get any interest rate changes. All right. If you've made it this far, hang with me. I know macro is not fun, but it's going to come full circle and it's important. All right. So again, it looks like as we head into end of Q3 to Q4, November, December, it becomes increasingly more probable that we do get our first interest rate cut. Now, with the stage set, again, knowing that we have FOMC Wednesday and then two important jobs reports being initial jobless claims and U.S. unemployment coming Thursday and Friday, let's dive into the charts and see why that matters. All right, so let's jump over to TradingView now. All right, so here we are. This is the S&P 500. Okay, now I have made videos like this before, so you've probably seen it, but I feel like whenever we have these meetings or these, these very important sort of economic weeks, it's important to issue refreshers because I find that people sometimes forget. So here's the S&P 500. What we're going to do is we're going to overlay some of the information that we have coming up this week. So as we mentioned, we have FOMC, which is our interest rate decision. So that's going to be the effective federal funds rate. We also have the United States initial jobless claims. Okay, put up down below as well. And then we also have the U.S. unemployment rate. Okay, so we're going to put up all three of these down below. Okay, and again, all of these are reporting this week. Okay, so the top one is going to be Wednesday, the middle one is going to be Thursday, and then the bottom one here is going to be Friday. All right, so we'll go through them one at a time. All right, so we'll start with the one Wednesday. All right, so we'll put these down below. What do we notice here? So again, here's the S&P 500. And here, maybe I'll just put this in a line chart. Yeah. All right. So I will label this right here. So this is SPX. All right. This is, just think of this as the stock. People are like, what is this? Just think of this. People are like, oh, is the stock market doing well? Is the stock market not doing well? This is what they're talking about. Okay. This is like your basket of stocks. All right. So when we put up the effective federal funds rate below, which again, we have a meeting on Wednesday to determine whether our interest rates in the US are going to remain the same as they are, or they're going to be modified either up or down. And we already went over the probabilities. 97% chance that they stay exactly where they're at all the way through September, and actually probably even going to be into Q4. So we'll see what happens. But what typically happens here when we overlay, and I'll just keep it on a separate pane for now, just because it's a little quicker. When we overlay the SPX or the stock market with the effective federal funds rate going all the way back, this is almost 3 decades here. This is back into the 90s. All right, what do we notice? Well, when we start cutting interest rates, when they start cutting, I'll mark it out with vertical lines, interest rate cuts, you can see pretty clearly here that as interest rates drop, so does the stock market. They happen at the same time. All right, now we're going to continue onwards. What happens here again? Interest rates are hiked. We go sideways, they pause, and then they start to cut interest rates. And look at what happens here at the same time with the stock market. Stock market goes down. All right, keep on moving. Now, what happened over here? Again, this was in more recent years. They start to cut interest rates after being paused for a little bit. And then what happens? Technically, we moved up a little bit more, but we did, have a pretty nasty crash there following. So again, typically what happens is after a Fed tightening cycle, as we're coming in, to the tail end of the pause into cuts, typically you're getting a correction. Now, why is that? Well, there is a lead and a lag to this stuff. So let's put it this way. The hikes that happen right here, okay, so they're hiking interest rates, are not being felt until right here. Okay, so when they start hiking interest rates, they're not being felt for at least a year later. Okay, there's a dramatic lag to all of this stuff. All right, so again, similarly, where are they're hiking interest rates right here, and they're being felt, and this was largely due to COVID, right? But you're starting to feel these interest rates, settling into the economy later. All right. So what's happening right here? Again, they are hiking interest rates. Initially, there was a gully in the market, but nothing too crazy. It was a bad year, right? But where are here's our projected cut around here, right? We don't know exactly when. These hikes are going to start being felt somewhere over here, and again, it could be out in 2025 or even 2026. Time will tell, right? But I want everybody to just understand what typically happens to the stock market. And of course, given the correlation between stocks and crypto, especially in recent years, it makes sense to be a little bit cautious once we are through our Fed pause, which is looking like, according to the probabilities table that we just looked at, sometime towards the end of this year. But again, things can change pretty dramatically. All right. Now, we're going to talk about the next report. All right. So again, we just talked about interest rate policy. And again, we're supposed to remain paused, all the way to September, potentially even later. And again, look at what happens, during a Fed pause typically. I'll just add on when we actually became paused. And this was a little weird, right? Like technically we were kind of like paused over here and we had like minor little adjustments. But in my opinion, this should be viewed as your hike, and then all of this up here is your pause. Look at what happens to to the stock market during a pause. Okay, typically the market performs extremely well. Here, I'll just add this on here as well. So here's our pause. I can make these different colors, right? But point being is like this is here. I'll just draw these out real quick, just because I like it to be clear. So this is your Fed pause territory right here. Fed pause, and then again right here, Fed pause. Market's doing very well. Again, Fed pause. Even through the first batch of cuts, you can see the market did very well. And then what's happening right here? Again, markets are moving up. We'll see what happens. But again, until we start to get those cuts, there's no reason to think that this time would be materially different than, going back 3 decades. Okay. So now that we've talked about this, and again, I think it's really important to set the stage. Like, we should have some time. We should have plenty of time, as a matter of fact. Let's add on another piece of data. Okay. Right here, we have initial jobless claims. Okay, this is people start filing for unemployment. We start to get our batch of data that is basically indicating, okay, look, people are losing their jobs. Okay, people are losing their jobs. So what typically happens, at the same time, and here, actually, let me get rid of the SPX here. So right now, we're just going to look at federal funds rate and the initial jobless claims. And I mean, I could throw up unemployment as well, but I feel like we're just kind of going through it, kind of in a sequence here. So what typically happens here as they begin to cut interest rates, right? Let's draw some more lines. Effective federal funds rate is orange. Initial jobless claims is in kind of this light blue down below. All right. So they start to cut right here. And what do we notice? And move up slightly before that, more or less at the same time, but slightly before that. Okay. Again, what happens right here? They start to cut. Initial jobless claims moves up. Again, they start to cut here. And this was COVID, right? So this was pretty goofy. But again, same exact thing right over here. And how about this point in time, right? Going even back to the 80s, right? They start to cut interest rates and initial jobless claims are moving up. The reason they're cutting interest rates is not just for fun, not just because they're like, oh, let's just cut interest rates. Everybody wants cheaper debt. No, they're cutting interest rates because there's something under the surface that is dictating them to cut interest rates. Okay. If the economy is in a healthy state and can maintain and hold at its current interest rates, they're not going to cut. They're not going to cut of it unless maybe we have an administrative change and, somebody really is motivated to, try to prop markets up or something. But typically, you are not going to see interest rate cuts unless there is a reason and they have to cut. Okay. And in this case, what have we seen in all of these examples? They're cutting because people are losing their jobs. Again, they're cutting here. You can start to see that, initial claims are, they bottom and they slowly start to move up, and then they have to step in and actually cut interest rates. And the reason that we're so focused on initial jobless claims and, kind of just using this as well. One, we have the effective federal funds rate interest rate decision policy this week, Wednesday, for FOMC. The next day we have initial claims, and then the day following that we have unemployment. Okay, so not only are these, in my opinion, the most important, they're the final dominoes to fall when things really start to hit the fan as people lose their jobs last. But we also have them all reporting this week, so super important. All right, now let's add on the unemployment rate. We're going to get rid of the initial jobless claims right now. I don't like this yellow color. We'll change this to red. All right. So this is the unemployment rate here in the US. This is the effective federal funds rate. Okay. Again, what are we seeing here? Same exact thing as initial claims. They're very, very close to each other, more or less kind of representing the same thing at the end of the day. But what are we seeing right as they're cutting interest rates? Again, even going back here to the 90s, they're cutting right here. Oops. And what are we seeing right here? People are losing their jobs as they're cutting. Again, people losing their jobs and they're cutting. Okay. Again, people losing their jobs and they're cutting. So you're understanding now the relationship between Fed policy and the jobs market. All right. And how this all, sort of connects and why it's so important and why this week is so big and why there's a lot of chop and turbulence and fear out there is, you know, right now everything's fine. Like unemployment, the unemployment rate is still sub 4%. We're for sure in, a pretty standard and typical Fed pause territory. But again, things can change quickly because when it happens, it starts to happen, relatively quickly. So let's get rid of initial claims, and we'll just keep up, the unemployment rate, federal funds rate, and the S&P 500. Okay, so this is a lot of information to look at here. But again, we're gonna throw that and just you'll see the relationship very, very clearly. All right, very, very clearly. So cross lines here. What happens when the Fed starts cutting? Again, S&P 500 goes down, interest rates, they start cutting, people lose their jobs. All right. Same thing right over here. And even this was in 2007, 2008. People are like, how could you have seen like the housing crisis coming? How could you have predicted? Well, I mean, I was pretty young at the time, right? I was pretty young. I wasn't, I was 10 years old at this. But again, they start cutting interest rates, the market starts to roll over, and people begin to lose their jobs. Again, it's the same exact thing. All right, and what about here? I'll keep that like that. What about here? You know, what about right here? COVID was a little bit of a weird instance, right? But they start cutting interest rates. You're starting to see the news. People start to lose their jobs, and we have a huge crash in the stock market. Again. So what am I expecting right now? I'm not expecting another COVID. This was a really weird little example, but again, it's still a relevant one. It still happened. It just happened a lot quicker. They've given you their for where interest are going to be going into the end of this year. So again, here let's just assume it's like early October. We'll kind of split the difference. It's going to be probably September, October, December where we get our first batch of cuts. But it's possible too that the labor market remains more resilient and they actually can remain paused all throughout this year. What would we expect? What would we expect? We expect this to go sideways, and then they would start to cut, like this, right? And we would see them drop interest. I don't know where it's going to go, right? I'm just saying, like in typical fashion, this is kind of what you would expect to see. All right, and then what would you expect on the other side of that? For unemployment or initial claims, right? You'd start to see right around the end of this year, unemployment rate creep above 4%, and move up like this. Make this red so it fits. At the same time, what would you expect for the stock market? Probably continue to rally through the end of the year into Q4. And then, we get some big correction, wherever it may go, as soon as they start cutting interest rates. So again, this time shouldn't be any different, but the big takeaway really needs to be that there is not a reason for us to really start panicking until we start to see the Fed intervene and drop interest rates. So again, we'll see what happens this week. We could always get a surprise report, anything can happen, right? But if the stock market is going to remain strong through the end of the year because they're going to remain paused and the labor market is going to remain resilient, which, I think should be the natural assumption, then I think we have to look at this and go, I'll just keep both these, whatever. All right, we're in a very clean range here. I mean, look at our range high, look at our range low, look at the bottom at the mid range here. We've now broken out, we're in price discovery. We know that, we should remain strong and equities and crypto should rally all the way through, at least up until the Fed begins to cut interest rates. So we see unemployment begin to slowly creep up, probably above like 4.25%, honestly. 4% maybe would be enough to spook just because we've been so low and below 4% for so long. But we really have a lot more this upward, upward rally, the stair step up, basically until the Fed steps in. So big week, right? Hopefully the labor market data is still strong and people still have jobs, and we don't really see the probabilities table, change too dramatically for, what the market is pricing in terms of when they expect the Fed to intervene. But understand what them intervening really means, right? What does it really mean? Well, them intervening and cutting interest rates isn't just for the fun of it. I suppose there's another side to it where it is, an election year, and all that stuff. So maybe there's some politically motivated reasons to keep the market propped up, which is again more bullish. But they're not going to intervene and start cutting interest rates just for the fun of it. They're going to do it because they're seeing something under the surface. So we'll keep an eye on the probabilities table. But again, they're not expecting, the market is not pricing in, really any cuts. Again, right, going back to the table here, they're not expecting any cuts at least until September. At least until September. And again, that could change. We'll see what Powell says this week, Wednesday. But it looks like the cuts are coming in Q3 and Q4. And what we know historically is that it would be very atypical to see the market, really begin to sell off and go risk off before we start to see poor jobs data and before we start to see the Fed really intervene. So, wow. All right. This was 10 minutes max, but it was actually 21 minutes. But again, this is a big week and this stuff is important because if the stock market pulls back, Bitcoin's going to take a hit. Your altcoins are going to take a hit. So again, as this asset class is maturing, it's important to keep an eye on all of this stuff. And we here at BB are here to narrate it all for you. But guys, thanks so much for tuning in. I know it was a long macro video, but again, it was important. So I hope you can see why it's important to discuss this and what there is to look forward to this week. Thanks so much for tuning in. Please like and subscribe and check out the first link in the description below. If you want to see behind the curtain at how me and the rest of the Because Bitcoin team trade, check out the first link in the description below. That will take you to our website where you can sign up for our premium Discord. We do over 2 hours a day of private live voice calls where we do Q&A, share all of our active positions and premium analysis that we don't talk about here on YouTube or on Twitter. So again, great value. And within the next 30 days, you are going to get free access to our new flagship product called the BB Terminal. Basically a Bloomberg terminal, but for crypto guys. You're going to get spaghetti charts, portfolio tracking, derivatives data, heat maps, everything that you need to know, everything that you are going to need to find your edge and succeed in these markets. Again, conveniently bundled into a super website created by us here at BB, and you are going to get it for free included in your existing Discord membership. So definitely sign up sooner rather than later. And if you want to expedite your journey towards understanding these markets, we just finished our new BB Academy. That's the second link in the description below. There's a lot of garbage out there. There's a lot of people trying to teach you TA and FA and how to trade. We took it upon ourselves to create and bundle an extremely affordable and fairly priced super academy. All right. And again, it's very fairly priced. Prices are going to go up soon. Again, it is tremendous value. If you want to learn how I do TA, how the rest of the Because Bitcoin team does TA, how we do FA, we really share all of our secrets and how we approach markets as a team. If you want to expedite your journey towards understanding these markets from a technical and fundamental side, definitely consider checking out the first link in the description below. We can save you weeks, months, quarters, years of time trying to, learn how to do all this stuff. We can cut through all the garbage and we conveniently lay it out all for you here in BB Academy. And again, you don't want to learn the wrong stuff. You want to learn the right stuff. And we've given away everything. We put it all right there for you guys to learn. So that's the second link in the description below. But guys, thanks so much for tuning in. Just a friendly reminder, please consider liking and subscribing, and we will see you next time. Take care.